Hello and welcome to Forex Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at trading breakouts. In the area of finance trading, and in particular within the Forex market, the movement of a currency pair or price action does one of three things. It moves up, it moves down, or it moves sideways. With these types of moves, especially when the price action is moving up and down, we will find trends forming. We will also find pullbacks or price reversals, continuations, slowdowns in volatility, and pauses and hesitations, which are also known as periods of consolidation. Typically at these times you might see very small movements, where price moves sideways in a narrow range. In other words, currency exchange rates in the Forex market do not travel in continuous straight lines, and this is what makes trading so difficult to predict. Each time you pull the trigger and execute a trade, and especially as a retail trader, you're up against institution traders including sovereign wealth funds, hedge funds, governments, and their central banks and high net worth individuals, all of whom might well have a different price movement expectation than yourself and be trading in the opposite direction. In other words, against you. This is why it's so important to learn the peculiarities, twists and turns, the dynamics and unpredictability of the Forex market. And the best way to do that is to study your charts and to study the markets and to practice on a demo account. In other words, learn the ropes, find the best time of day to trade that suits your trading style and methodology, and try and determine when the aforementioned big guns are likely to be singing from the same hymn sheet. In other words, when the majority are trading in the same direction. One of the most popular and rewarding styles of trading the Forex market is identifying breakouts. This type of trading relates to technical analysis only. That is not to say we cannot take our eyes off the fundamentals, because these events can be triggered by economic data releases. However, after periods of consolidation, where price action becomes narrow and congested and shows a lack of direction, traders look for potential breakouts to test new levels, and these events regularly occur purely on technical analysis alone. Because breakouts are so popular, price action can be extremely volatile at these times. It's almost as if everybody pounces to trade at the same time and either buys or sells a particular currency pair because their charts tell them so. This tends to cause strong moves as price breaks out of bottlenecks, and where quite often those entities that are trading counter to the breakout may be stopped out of their trades. This is often because breakouts regularly happen at or close to round numbers. At these levels, traders tend to place their stop losses or limit orders to buy or sell. This can often result in a spoof breakout, where price action breaks out of a period of consolidation only to reverse quickly and start a trend in the opposite direction, and therefore some breakouts can be short-lived, and which are also known as false breakouts. Let's turn our attention to example A. This is a 1-hour chart of the Euro-USD pair. Always read your charts from left to right because it tells a story of where price action has been and where it possibly is going in the future. In this example, we can see that we have drawn a horizontal line at position A. This has become an area of support. It is effectively a floor. Although we have a high as marked at position 1, and where price action moves back to our floor, the second move higher at position 2 becomes a lower high than position 1. This tells us that the market is running out of momentum to the upside, and where indeed price action returns to the floor after this push higher falters. Next, the price action forms a new lower high at position 3. This now tells us that bull traders have effectively thrown in the towel, and then, when price action returns to the floor, we see a breakout as marked by the X. This punches through the floor or support level. Therefore, this would have been the breakout candlestick that traders were looking for in order to go short on this pair. Price action continues to move to the downside, however we now see a new floor at position C and a new ceiling at position B, and where price action consolidates in a sideways trading fashion. In example B, we have moved the charts along to see the next session. Price action continued to trend sideways between the ceiling marked B and the floor marked C. This is until a second breakout occurs, and where price action punches through to a new floor marked D, and where the previous floor C has now become a ceiling. Again, price action returns to consolidation or sideways momentum until eventually at candlestick marked X, a series of strong bearish candlesticks forms another breakout to the downside. Had we entered a short trade at the first breakout to the downside in example A, we could have realized a profit of over 180 pips. An important lesson to learn from this section is that breakouts often occur when price action punches through floors and ceilings. These are also known as levels of support being the floor and resistance being the ceiling. So keep an eye out for possible breakouts, and especially at key levels where support and resistance levels begin to fail. They will be far stronger in momentum and after extended periods of consolidation. If you enjoyed the video, please like and subscribe, and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.